very important topic, that is marginal and absorption costing. Before we start the marginal absorption costing, we will revise our basic concept. What is your product cost? Product cost is equals to prime cost plus factory overheads. What is your prime cost? Direct material, direct labor, and direct expenses. And in factory overheads, we have two types of factory overheads: variable factory overheads and fixed factory overheads. This is your prime and this is your factory overheads. Now, period cost. Period cost is equal to selling and distribution administration, research and development, and finance. Before we discuss the technique of marginal and absorption costing, we should know the accounting treatment of product and the period cost. What is the accounting treatment of product and period cost? This is your product cost, this is your period cost. Accounting treatment of product cost. When I talk about the product cost, when we are going to make the profit and loss statement, how we will account for the product cost? Product cost is charged as sold and unsold unit cost. Sold and unsold unit. Sold units and unsold units. Sold unit cost is charged to the profit and loss account as cost of sales. Unsold unit cost is charged as closing stock in balance sheet. So whenever we charge the product cost, we divide it to sold and unsold unit cost. Whereas when we see the accounting treatment of the period cost, all cost is charged to profit and loss account irrespective of production and sales volume. What is your production? What is your sales volume? It doesn't matter. All cost is charged to the profit and loss account irrespective of production or sales volume. So this is very important concept which relate to the margin and absorption costing. Now we will come to our point. What is marginal and absorption costing? These are two profit techniques having different viewpoints. marginal costing versus absorption costing. Product cost, absorption costing, product cost in marginal costing. Period cost in absorption costing and period cost in marginal costing. So we will list down the elements of the cost, that is direct material, direct labor, direct expenses, variable factory overheads, fixed factory overheads, variable selling and distribution, and administration, fixed selling and distribution, and administration. This is the major cost. Now we will pick one element and decide whether it is as a part of the product cost or the period cost. In general accounting, we said direct material is part of the product cost. Direct material is part of the product cost. In journal accounting. Now we have to decide in the absorption costing whether direct material is product cost or not. So when we talk about the product cost using marginal and using absorption costing, there is no conflict. Direct material is part of your product cost. There is no conflict in these accounting techniques. Direct labor, generally we classify as a product cost. When we discuss in the marginal and absorption costing concept, again, there is no conflict. Direct labor is part of the product cost using absorption and marginal. Then direct expenses is your product cost. Again, there is no conflict in marginal and absorption costing relating to the direct expense. In other words, prime cost is same in both costing method. It is treated as product cost. When we treat any cost as a product, it is divided into sold and unsold units. Okay, and sold and unsold units, whereas the period cost is charged 100% profit and loss account. Now, variable overhead, it is generally classified as product cost. Again, there is no conflict in marginal and absorption costing relating to the variable factory overhead. These are your product cost. Variable selling and distribution. Again, these are your period cost. No conflict in marginal and absorption costing. It is treated as period cost under absorption and under marginal. Variable selling and distribution and administration. Variable selling and distribution and administration. Fixed selling, distribution and administration. Again, these are period cost. So there is no conflict relating to the fixed selling and distribution and administration. Here we see there is no conflict related to the maximum cost element. So there is only a one conflict point, that is fixed factory overhead, not the fixed cost. If you use the word fixed cost, it is a broader term. It includes fixed selling and distribution also. So please focus the point of difference or the conflict is fixed production overheads or the fixed factory overheads. Keep in mind there is two major classification of cost. Cost may be either fixed or sorry, either product or either period. According to the concept of absorption costing, factory overheads are treated as part of your product cost. But marginal costing concept differ from little bit and said it is treated as period cost. It means it is treated as non-manufacturing cost. Both costing techniques or the profit techniques have their own viewpoint that supports why it should be product and why it should be period. According to the absorption costing, these are the part of the product. Why? Because it relates to the production. You need factory for the production, so rent expenses there. Okay, so they said these are incurred because of the production. That's why these are part of the product cost. But in absorption costing concept, these are the overheads which are incurred even your production is zero. So they have no interlink with the production. That's why these are treated as non-production costs because if you have zero production, you are paying these expenses. This is the conflict point between marginal and absorption costing. When this conflict arises, it means the accounting treatment differ. When accounting treatment differ, your profit will differ. In absorption costing, we will absorb fixed factory overhead in product cost. But in marginal costing, we will treat the fixed factory overhead as a period cost. Fixed factory overheads. We will treat the fixed factory overhead as a period cost. When it is treated as period cost, it is charged 100% with 100% in income statement. But when it is charged as a product, it is divided into sold and unsold. This unsold units, suppose are 80% units are sold, then 20% cost is carried forward as a closing stock in balance sheet. The difference arises because of this 20% which we carry forward in inventory as an inventory in the balance sheet. Clear? This is the whole concept of marginal and absorption costing. Now we will discuss the performa of profit reportings, how we will prepare the performa. Okay, profit and loss statement using absorption costing. The most important part is working. Working is calculation of product cost. First, you have to calculate the product cost. Product cost includes, as we just discussed, all the elements: direct material, direct labor, direct expenses, variable factory overhead, fixed factory overhead, absorb. This is your product cost. Now, in absorption costing, fixed factory overhead are absorbed in the product cost. So you have to calculate under and over absorption of overheads. The most important point when we will calculate under and over absorption in absorption costing, the key point is when your budgeted production volume differ from the actual production volume, you will calculate under or over absorption. In the question, we will see what is your budgeted production volume and what is your actual production volume. If these are differ, then we will calculate under or over absorption. Okay. We will compare actual fixed overheads with the absorbed fixed overheads. This all information is given in the question. If actual fixed overhead is not given in the question, you will use the budgeted as a actual. How we will calculate absorb? We have learned in yesterday class, OAR multiplied by actual activity, we will get the absorbed overheads. If it is under absorption, and we will add in the cost of sales. If it is over absorption, we will less from the cost of sales. Calculation of closing stock units. How we will calculate the closing stock units? Opening stock units plus production units less sales unit. We will calculate the closing stock. Calculation of cost of sales. How we will calculate the cost of sales? Opening stock and cost of units produced. We have cost of units to be sold figure. Then we less the closing stock and we will get unadjusted cost of sales. Why it is unadjusted? Because we have adjust under or over absorption. If there is under absorption, it means we have charged less cost, we have undercast the overhead cost. That's why we will add in the cost. If we have overcast the cost, then we will less this cost. So the main focus is on the working. So we have sales less cost of sales. We will get gross profit. Then we will less non-production costs, variable selling and distribution, variable administration, fixed and finance, research and development expenses. We will less all these costs from the question from the GP and we will get the net profit or loss figure. This is the performer for the absorption costing. The most important or the learning point is when we will calculate the under over absorption in absorption costing, we will check, we will see the budgeted production volume, we will compare the budgeted production volume with the actual production volume. If your budgeted production volume differs from the actual production volume, then you have to calculate the under or over absorption in partial absorption costing. Why we calculate under over absorption in absorption costing? Because overheads are absorbed in the product cost at the start of the period using absorption rate. Now we will see the performa of marginal costing. In marginal costing, we have very much less workings, reduced working because major workings is done in the absorption costing. First of all, we have to calculate the product cost. Product cost includes direct material, direct labor, direct expenses, variable production overheads, and only fixed production overheads not included in the product cost using marginal costing. Why? Because according to the marginal costing, these are the part of your period cost. When we charge as a period cost, we will charge 100% in profit and loss account. So we have calculated the cost of sales, opening stock plus production unit cost, less closing stock units. We will have the variable cost of sales. Then we will calculate the marginal costing profit, sales less variable cost of sales. We will get the gross contribution. Why this gross contribution? Because for the calculation of contribution, we will less all the costs production and non-production cost. Okay, variable production and non-production cost. Then we will calculate the contribution. Then we less all the fixed cost, fixed production and fixed production, non-production costs. We will less and we will find the profit. Marginal costing is also known as direct costing or variable costing. Why? Because it is based on, it is focused on the concept of variable cost. To cover the variable cost first, then we will talk about the fixed cost. Okay, this is all about the marginal and absorption costing. Keep in mind, this is very important concept. Marginal costing concept is very important. Why it is important? All the decision making is based on the marginal costing concept. It means part B of the paper is based on this concept. This is very, very important to have strong grip on the marginal costing. If I will conclude marginal costing, I said in marginal costing, we will not calculate the GP. Instead of GP, we calculate the contribution, and contribution is equal to sales minus variable cost. Variable cost includes two costs, that is variable production cost, variable non-production cost. Variable production cost includes direct material, direct labor, direct expenses, and variable factory overheads. Non-production includes variable selling, distribution, and administration. Then we have profit or loss using marginal costing, contribution minus fixed cost. All the fixed costs, production, fixed production, and fixed non-production. Okay. Now we will discuss the practice question on it. A company commenced the business on 1st March, making one product only. The cost card, which is as follows. Direct labor is 5, direct material is 8, variable production cost is 2, fixed production overhead is 5, standard production cost is 20. Your journal or the standard production cost is 20. The fixed production overhead figure has been calculated on the basis of budgeted normal output of 36,000 units per annum. What is your budgeted volume? Budgeted units is 36,000 units per annum. The fixed selling, distribution, and administration expenses are fixed is 10,000 per month. Variable is 15% of sales value. The selling price is 50 per unit, and the number of units produced and sold one. Produced is 2,000 and sold is 1,500. Prepare the marginal absorption costing statement for the month of March. We have to prepare for the month of March. This is given annually, so we will convert it into monthly 36,000 divided by 12. Your budgeted production volume is 3,000 units per month. What is your actual? Actual is 2,000. Your actual production volume is different from the budgeted production volume, so you have to calculate under and over absorption. We have already absorption rate that is 5 per unit. Okay. We have budgeted units of 3,000. In the question, whether we have given actual fixed production overheads. No, actual fixed production overheads is not given in the question. So, when actual fixed overhead is not given in the question, you will assume your budgeted fixed overhead as actual. And then you will compare with the absorbed fixed overheads. So, to solve this question, first of all, we solve this in absorption costing. And first of all, we will calculate product cost. Calculate product cost per unit, which is already calculated. So I not need to write again and again. Your product cost is 20. Second, now we have to calculate the closing stock. The business has commencing on the 1st March, so they have no opening stock. Calculation of closing stock units. Opening units plus production units minus sales unit. How much opening units? It is nil because the company has 1st year of the business. Production unit is 2,000 and sale is 1,500. We have 500 units closing stock. 500 units are in your closing stock. Now we have to calculate under and over absorption. We decided at the start of the question, calculation of under over absorption. Actual fixed overheads. How much is your actual fixed overhead? It is not given in the question, but the budget is assumed as actual. So we will multiply 3,000 into 5. We will get 15,000. How much is your absorbed fixed overheads? Absorbed fixed overhead is, absorption rate is 5 into actual units. Actual unit is 2,000. This is 10,000. We have under absorption of 5,000. Okay. Now we will make the profit statement. What is your selling price? Selling price is 50 and 1,500 units is sale. Fixed selling and administration expenses is 10,000 and variable is 15% of sales. Now we will calculate the profit and loss statement. Profit and loss statement using before profit and loss statement, you have to calculate the cost of sales. Calculation of cost of sales. Opening stock is nil and cost of units reduced. We produce 2000 units and cost of 1 unit is 20. We will get 40,000. Cost of units to be sold. This is your cost of units to be sold less closing stock. Your closing stock is 500 units into 20, you will get 10,000. 30,000 is your unadjusted cost of sales. And under absorption, is 5,000. So we get 35,000. Adjusted cost of sales. Now we can easily solve the statement because we have done all the working. Profit and loss statement using absorption costing. First of all, I have sales, 1,500 units into 50 is your selling price. That is 75,000 less cost of sales, 35,000. We will get gross profit figure. $40,000 is your gross profit, less non-production cost, that is fixed selling and administration is 10,000. Selling, distribution, and administration is 10,000. Variable is 15% of sales value. Sales value is 75,000 into 0.15. You have 11,250. Add rest these figures. 40,000 minus 10,000 minus 11,250. You will get 18,750 is your profit using marginal cost. Now you people try the absorption cost, marginal costing profit statement.